Downside reversal. We're coming to the end of the year, so it's probably time to make some resolutions as well. We're going to talk about those things today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about the options market, the stock market, whatever happens to be coming to my mind, and take your questions. We had a big downside reversal today. For those that don't know, a downside reversal occurs when you have something essentially open at new highs and then break sharply lower. It's a technical formation, so the reasons aren't important, but in this case, we might as well talk about what those reasons are, and I'm talking, of course, about silver. I have it up on my chart right now, so we can do a little screen share perhaps with that, or can we? Did I do my screen share thing? I think I did. Okay, so what are we looking at here? You know what, I should probably have a separate chart first. We'll do this. We're going to look at this a couple different ways. First way we're going to look at this is just a long-term price chart on silver. This isn't even that long-term, believe it or not. It looks like it is. This is the 5-year chart, and this is a long-term chart. Goes back to the 1950s. This one I should probably put as a logarithmic chart because, of course, the precious metals are going to be impacted, like everything else, by inflation. And consequently, if we look at it in a really long, basically in a really long time horizon, you can't even make out where it was initially based on how high it has gotten more recently. But this first chart here, is a ratio chart of gold versus silver. And if we look at this more recently, this was actually an observation that was first brought to my attention by Carter Worth late last week. And in this particular case, I've got silver divided by gold, but why don't we look at it a different way? I'll just go the other direction. And we'll look at gold divided by silver. That probably makes a little bit more sense. I'm going to get rid of the normalization here, which is one of the things I had baked into the cake. But why don't we back this up just a little bit more. We'll go back to 2005. And that relationship is reflected down here on the bottom. And what we can see is that, we got to a situation where it started to get somewhat elevated, and that relationship was one where it looked like it might be time to potentially sell silver, buy gold as a pair, just as it had outpaced. Obviously, one of the best performing things so far this year. Now, we'll talk a little bit about the reasons. Why did this happen? Well, the CME, the Chicago Mercantile Exchange, which now owns the exchange where gold and silver trade. So, actually, when I was a member of the New York Mercantile Exchange, the New York Mercantile Exchange, the New York Board of Trade, and several other exchanges were actually all part of effectively one entity. All those exchange floors were at One World Financial Center, right at the north side of the North Cove Marina in Battery Park City in Lower Manhattan. And the New York Mercantile Exchange and all of those other affiliated exchanges were picked up by the Chicago Mercantile Exchange. But in any case, I actually trained the traders at our firm that traded options on gold. And I was on that floor fairly frequently. But it's now part of the Chicago Mercantile Exchange. In any case, one of the things that will happen is that from time to time, exchanges will adjust the margin requirements. Different things can cause the exchanges to do this. One of those, of course, is a material change in price because the size of the contract will change. In the case of silver, which was trading, below 30 at one point this year in April and got as high as north of 80 today, the value of any given contract, if you had a fixed amount of margin required, well, what would essentially mean is that the margin requirement would be going ever lower as the underlying asset appreciated in price, which wouldn't make much sense. So you would obviously have to adjust it to account for increases in price in the underlying asset. But the other thing that they will do is take a look at volatility. So as volatility rises, they can also raise margin requirements for that reason. And one of the interesting things about commodities is that unlike equities, very often they exhibit a positive skewness. And that is to say that the volatility of some commodities and basically the more volatile the spot market is, the more likely this is to be true. Sometimes commodity volatility actually goes up as the underlying price goes up. If you want to imagine how, when, and where circumstances like that might occur, consider very hard, situations where the supply and demand imbalance can be disrupted very suddenly and very violently. A perfect example would be something like electricity, because electricity isn't easy to readily store. So supply and demand imbalances can move all over the place and with extreme speed. And that's more likely to happen when there is a significant amount of demand that outstrips the available supply of power. So a generative plant goes offline, everybody turns on their air conditioner in Southern California, and suddenly you have a real problem. And electricity prices can spike materially. So that would be another reason why you would potentially see an increase in margin in conjunction that's even larger than you might expect. Now, of course, if you increase the margin requirements, then that's going to create margin calls for some people who are in it. Some will meet those margin calls, others will not. Those that do not are going to end up selling their positions, and consequently, when you sell those positions, this is one of those things you get. So one of the things we can actually take a look at, which I think might be interesting, is that the precious metals, maybe more so than most other commodities, tend to trade more like stocks, generally because they don't have these kinds of really violent supply and demand imbalances. So the reason I'm interested in looking at this is because one of the things we want to see is this skewness accurately baked into the cake? And here's what I'm talking about. You can see that the upside calls are trading at a material premium to the downside puts. And just so that we can really get a better handle of what that looks like, I'm going to put in the SPY ETF, since we're looking at ETFs, and you can now compare and contrast that relationship. And you can see that upside call options, the 105 strike call options, for example, in SPY, or the 110 strike call options in SPY, are indeed lower than the at the money options are, and the out of the money puts, 95s and 90s, are considerably higher. Compare and contrast that then with what's going on in silver, and what do we see? We can see that these upside strikes are higher, and we can see that the downside strikes are lower. Any case, I just thought this was kind of an interesting teaching moment about why you might see something like that exist. Okay, so we'll move on from that. Looks like we're also getting some questions here. And it looks like one of them is about gold. But let's see. I'm going to start with this. So first of all, wasn't around last week, so we weren't able to do open mic. I'm assuming most of you were probably not going to be watching it anyway, since Wednesday was only a partial day anyway, a big holiday week. Hopefully some of you guys were traveling or doing something fun for the holidays. I was out of town. I went to Hawaii. I went to Oahu, I went to Waikiki, a place I hadn't actually been before. And I'm hopeful that consumers were feeling as good elsewhere as they seem to be at all of the shops there, because I've never been to Dubai either. I don't know if that's a bigger shopping mecca than Waikiki is, but I've never seen anything like it. So I can't remember going through stores and places like that, which I had to stop into for all. Inevitably, one forgets to bring things that looks like it did there. But wow, that's all I can say. So hopefully everybody enjoyed the Christmas week. But that's where I was. One of the things we did while we were there, as it happens, was go to Lululemon. We happened to go to Lululemon because my wife likes Lululemon, and also because with the American Express card, every quarter you get a $75 credit, so you might as well go there and find a couple of items. Inevitably, you end up spending a lot more than $75, so it's not like you're getting free stuff, but it looked like it was pretty busy in there. But in the meantime, we have seen something else happen in Lulu. We got some news that the founder is trying to get 3 people appointed to the board. And you add to that the fact that Lulu has Elliot involved. Oops, not mem. Wrong function. Elliot is a big, let's see, I don't know if it's reflected in here. We're going to see. May not have gotten an updated 13F. But I saw that they were taking a stake. Let me just, you know what, I don't even need to do that. I can go like this. Yeah, it's not showing there. But they have taken a stake, apparently. So, Lipo Investments, by the way, as you take a look at this, is the founder. That's Chip Wilson. Where's that? Right here. So he's got 3% of the outstanding shares. He's the 7th largest shareholder behind a number of... and actually, you see Wilson 5 Foundation Management. I'm going to guess that is also them, and also Shannon Wilson over here, probably also. And like I said, I know that I saw that Elliot had taken a stake. I'm not seeing it here. But they are activist investors as well. Add to that the fact that the stock seems to be, it's trading now above the 50 and the 100. If we're going to look at Carter Worth's favored long-term trend line, the 150, I believe it's also trading above the 150, although not above the 200. To me, I'm thinking that it might be time to, look at this as a potential bearish to bullish reversal. Now, I will say that it hasn't completely returned to the Holly Index. The Holly Index, as folks will know, it is obviously going to show up on my American Express bill, or at least my next one. My measure of consumer discretionary spending, because I'm not a big discretionary spender myself, don't go out and buy a lot of stuff. So I look to my kids, I look to my wife as a better barometer of what's popular and what is not. Interestingly enough, one of the questions we have here is about ON Holdings. Those are very popular shoes in my household. And Vuori, which is a privately held company, has become more popular than Lulu has. That said, I think there is a possibility that we're getting into a range here where also in terms of valuation, things are beginning to look a little bit more interesting. You can see here that the stock's expected to make $13 a share full year. Next year's estimates, as you can see, slight decline. This is not something we typically like to see. That wouldn't normally hit my radar. But I wonder if we sort of have a return, a back to basics type of situation, whether we might actually do better than that. So, the top line here is growing faster than the economy at or about the pace of inflation. And even versus that reduced number, which I suspect there's a chance that if they sort of right the ship, so to speak, that could improve things. That's only 16.8 times forward earnings. So it's not going to take a whole lot of improvement in expectations for adjusted net income, I think, for this one to find its footing. That combined with just the notion that there are activists involved, you're just going to get some other people, getting involved in on the chase kind of thing. So, and I don't know whether we're going to get other activist investors involved as well, but that can create some inflows. And it's not far off of its lows, so it's not like one's really missing the boat here. We're looking at the stock's 212. It was down in and around here. We're only looking at 180 and change. So we're up 15% off of those lows. But you can see it was basing in here for a decent period of time. So to my eye, I kind of get the feeling that this is probably the downside risk that one is facing here. If you're concerned about reaching out and buying the stock at these prices and are instead just interested in saying, okay, well, I want to get some potential upside and I'd be happy to buy it if it does happen to return to those levels, that's a situation where you might consider something like a call spread risk reversal. And actually, to that end, let's just take a look, because my expectation would be when you see this kind of news that sometimes you'll get a little bit of an uptick in options premium as people are expecting activists to come in and do things. We're not at a really high level just yet. This would probably take a certain amount of time to play out. But let's just say you wanted to do this in the longer term. We could go out to Feb or even a little bit beyond. Let's see. No, I don't know why. I sometimes put the whole ticker in and I'm not getting it right there. But so we could go out to Feb or something like that. I probably wouldn't buy the at the money calls. I don't really see the point. Maybe get these 220s, sell something a little bit higher, up around the 250 level, and then sell a downside put. We could look at something like the 200s. I might even go a little further out than that. I wouldn't normally, but something like this. In fact, actually, you can probably take this put strike down a bit. Say you wanted to do 185. This is going to have a net outlay in the example that I just provided, but the decay of those wing options is very likely going to be higher than the at the money. So even though it looks like even though it looks like you're going to be spending $4 in premium, there's a bit of time for that to play out. And I have a feeling that you're going to get a payoff that looks a lot more like this curved line for most of the time between now and then. And it's the kind of trade that I would probably suggest is going to need some modification at some point anyway, as time passes. So probably something we can look to revisit in late January, early February, if one was going to use that expiration. So something to take a look at there. One other thing, and I'll get into this a little bit more on Wednesday's open mic, because as the year is coming to a close, those of you who've been watching for a while know that I had my beginning of year acronym, which was Rising with 2 Gs, which was sort of like the best ideas for the year. And those securities, for anyone who doesn't remember, were RSP, which is an equal weight S&P fund, IBIT, which is the Bitcoin ETF, SCHH, INDA, the India ETF, NANCE, which was the Democratic, named after Nancy Pelosi, the Democratic sort of congressional stock trading tracker. There is another one for the Republicans, but the Democrats seem to have done a little bit better historically. Indeed, they outperformed the S&P, I believe, this year again. Did they? Yes, they did. Google, with the L, was one of them, NGLD for gold. So year's not quite over. Last trading day of the year will be Wednesday, so we might as well revisit it then. It does not look like I'm going to be the best performing analyst who participated in the acronym challenge for 2025 on CNBC, but we did outperform the S&P by nearly 8%, with a total return for that acronym to date of about 26.7% year to date. So not terrible. But we will look at each of those in turn on Wednesday. So for those of you who are available, be sure to come back and tune in for that. We'll go over each one of those, which parts of that trade I might be inclined to keep, which parts I might be inclined to discard. Okay. Jim Howard is asking about ON Holdings, which I mentioned. Very popular shoes in our household. So let's just take a quick peek here. So we have really very nice projected rates of growth on the adjusted net income front, which is good because the stock is trading not terribly cheap. We'll just use 47.5 and $1.30 to keep the math easy. 36.5%. Forward price to earnings of 36.5, but growing at 70%. 23% top line growth. Slowing a little bit. That's, you can see we had trailing 12 month 29.3. Would kind of like to see that growth holding a little steadier than that. 700 basis point decline year on year. So in other words, there was a decline from the trailing 12 months anticipated for the full year, but that's still year on year. We're looking at 29.4 for full year 2024 versus 29.3 for full year 2025. Not bad, pretty consistent, but 700 basis point decline in the top line growth rate. But it does look like otherwise things are pretty good. Very solid free cash flow growth is anticipated. So I think that is certainly a positive. In terms of volatility, which is what we're going to look at if we're interested in a buy right on holdings. You wanted to see some of the alt data. Let's look at that first. So Placer. Where is my Placer data? Did they ditch that? Let me go back to. Let me just check something. I've got Placer for Lulu. Oh, you know what? Yeah, so we're not going to have as much of that kind of thing for ON Holdings, of course, because unlike Lulu, there is not. You don't have all those locations to track, and that's what Placer's actually doing. It's geolocating all of the consumers. So you're not going to see that kind of thing. This, by the way, you may remember that I had mentioned this before, that their foot traffic was much better than the industry overall. I speculated on a prior live stream that things like that American Express incentive might be a part of that reason. And that's anecdotal, but I go into the store because I have access to that. I know other people who similarly were going into the store because they had access to it. So I have a feeling that's a fairly important driver. It's not like $75 a quarter is immaterial. $300 a year, people, they're walking through the mall and they're saying, I'll pop into Lulu, why not? So, I don't have the access to that, but we do have access to this. So the Bloomberg second measure data is not terrific for ON Holdings. The issue, though, and those of you who've been watching for a while will know this, personally, I haven't found... I'm a big Bloomberg user, right? So we know that. But Bloomberg's second measure, in my experience, hasn't been that compelling, admittedly. So I'm probably a little bit more interested in SimilarWeb's data, which actually has ON Holdings outperforming the industry, whereas their second measure data does not. But so split decision on the alt data as far as ON Holdings is concerned. But we can also take a quick peek here at implied volatility, options prices. So you'll remember the orange line. This is how volatile the stock has been. If you annualize it to an annualized standard deviation, over the course of the last 30 days. You can see it's at the lower end of this range. 1 month options premiums are as well. 1 month is probably, between 1 and 2 is probably where I would go for the buy right, probably closer to 2. 40% implied volatility is what you would get if you sold a 2-month option, which, as it happens, is, let's just compare that. And actually, I'm going to bump this up. I'm going to put 60 days in here. So that's a little bit below the average, but the important thing for us is, will those options be capturing an upcoming event or not? And they will not. So actually, so 40% implied volatility is not bad for ON holdings, given that, if you're selling an option that expires before March 4th, which is the anticipated quarterly earnings release date, that should be a very reasonable valuation. So yeah, I like it for a buy right. Let's take a look at what one of those might look like. And we'll see what we have here. So you would be buying the stock in a buy right like this and selling a call. Perhaps a 20 to 30 delta one. No, we've only got $2.50 strikes. That gets us a little less than 20 deltas, 60 cents. Maybe a 30 delta one would be okay for now, but that would look a little bit like this. Gets you $1.15 versus 47.5 stock. So you're getting 2.4% in premium collection over that period of time. Monitor this. If it loses 80% of its value in the short term, just close it immediately. You could potentially think about rolling down. Also keep an eye on the yield. So just take a look at however much premium is left in that option for as long as you hold it relative to the stock price. Take 365 days a year, however many days there are until expiration, or you just use 360, which is a finance calculation simplification that a lot of people use. Annualize that yield, and if it gets anything close to a risk-free rate, then you want to close it at that point as well. Those who are so inclined may also look to get similar yields by selling cash-covered puts. You will not have as much upside participation. In this case, you still have about 10% upside participation because you're selling the 52.5 call. Stock's trading 47.5. Gives you nice $5 to the upside. Okay, so I like that. Steve Garcia, I consider buying 300 shares of GLD today, but instead bought 100 and 2 times the January 2028 400 calls. Do you think this is a reasonable way to use LEAP calls? Thanks. So, well, let's take a look at this trade. We're going to actually build it so you can see exactly what you get. All right. And we're going to have the stock, and we're going to add a couple calls to it. 2 of these longer dated. Did I go right past it? January 2028, 400 calls like this. So you end up with a structure that looks a bit like that. Short version, I think that's fine. I would probably not have bought the at-the-money calls. I might have bought in-the-money calls, but you're laying out more. So basically trading a little bit of intrinsic premium for extrinsic. So reducing the amount of extrinsic premium I have and increasing the intrinsic. That would also increase my delta a little bit, reduce the decay. But you're not going to have a lot of instantaneous decay on these as it stands anyway. That is how you would do it. I know folks like Jim Cramer. There's a lot of people who have recommended trades like this as a way to sort of take on a little bit of levered upside, reduce the amount of decay that you have. So yeah, I think that's fine. I probably would have gone a little bit more in the money. Let's see what the January, because I haven't looked. Let's see what that looks like in vol space. So, where are the January 2028s? Doesn't show them. I probably don't have that expiration selected, but it'll look like this. So you bought this option right here in vol space, and if you got an in the money option, you're going to end up paying a lower implied vol. A lot lower? It's a little lower. But let's just compare those prices, and actually let's just compare those options actually. So now I'm just going to do a little side by side on the call side. So I'm going to select the ones you bought, which were the 400s, and I'm going to compare those. Get rid of this. And compare those to one that's a little bit more in the money. So let's go. I mean, I was just looking. Let's look at the lowest vol ones on the board, for example. These are about 25% of the current stock price, as you can see. But you'll notice here, take a look at the difference in how much premium you are spending. So these ones here are $60 effectively in the money. And these are, we'll call these at the money, right? Okay. But these ones only cost about 50% more. So you are going to have to lay out more money. That's true. But the benefit is you get more delta, lower decay. You're buying a lower implied volatility. So, you can kind of pick your poison. But if I was going to do that as a strategy, I don't typically do that. But, I know a lot of people who have done it and have done it effectively. And it's not because I hold anything against the strategy necessarily. I just tend to like, when I'm trading options, to be short premium, especially a little bit nearer dated than that, and long the underlying asset. But this is but if I was going to say, okay, instead of being long the underlying asset, what would I do on the option side? I'd probably be more inclined to do something like this. Because this thing, here's another way to think about it, right? If GLD ended right here, let's just say it didn't move. Let's say it closed evenly at 400 in 2 years' time. Well, these options are going to be worth $60. So you will lose $3,600. These options would be worth $0. So you would lose $6,200. So, now, of course, if gold rolls over completely, then you will have admittedly, you'll have risked less money to be in this trade than this one. But I think the purpose that most people are trying to take advantage of when they trade long-dated leap call options as proxies for stock is, they're saying, okay, well, I want to take somewhat less risk than the underlying stock has. But I don't want to lay out too much premium. That's one of the reasons you go far out in time, so you don't have a lot of decay, and you go in the money. And also going in the money increases your delta. So in the immediate term, if it goes up, you're going to have more exposure. But I don't mind the strategy you have. I mean, a lot of other people will also do things like ladder calls. So you might have a number of different strikes along the way, and then peel some off as you win and roll those up. So there's different ways to do this, but it's not terrible. I just offering that I probably would go in the money on those. Okay. Is it also possible this investment itself might be okay, but the timing is bad given the recent tear in GLD, SLV? So it is definitely true and worth considering that precious metals have absolutely been on a tear. And I will tell you that there were few things that would scare somebody on the long side more when I was on the commodity floors than a downside reversal. It's basically like the pinnacle of, bearish things that could happen. When something would open at fresh all-time highs and then close sharply lower, that was just, a disastrous technical pattern, whatever its cause. And like I said, was it overbought? Maybe. Had the ratio of gold to silver gotten too stretched on the silver side, as Carter Worth had suggested late last week, and then he actually reaffirmed it over the weekend. So anybody who came in this morning actually had an opportunity to put the trade on that he had recommended and would have done quite well with that. That's also possible, just the margin issues. And then finally, does it matter? I mean, whatever it is that's scaring somebody out of a trade, do we care that much what that is? Or do we care that that's what's happening? Is it possible that there could be a little bit further weakness in silver? Personally, I was less exposed to silver than I wanted to be, and as it took off, it was definitely one of the things I had my eye on, and just a lot of other things were going on, and I kept thinking, I might get a pullback and have an opportunity. Never did. So I wouldn't mind terribly if a pullback took place. I'm not wishing any ill will against people who are already in that trade. But that downside reversal is indeed a very scary pattern, and one that I think it's well worth respecting. Okay. So I'm not sure what the final question mark there was for, Steve, but I'm assuming... okay. Every clothing gift given among my family members for Christmas was from Fiore, not Lulu. Okay, so yeah, kind of the same thing here. Other than our trip to Lulu, which we actually did. Was that before Christmas? I think, was that right? Yeah, I think that was. Okay, so it was right before Christmas. We went into the Lululemon store in Waikiki, and bought some stuff. Easy to travel with because you spend a lot of money in a place like that and don't walk out with a lot of clothes from my perspective, but whatever. But yeah, it does seem like Fiore is more popular, still private though. So, the real question is, do we think that Lulu could stabilize if Chip and Elliot and others are able to sort of stabilize things? That's kind of the bet if you do something like that. So, FinWest, I've got a long stock position in Lulu by virtue of getting assigned on short puts from its prior earnings. I appreciate the recent bullishness to help dig myself out. You could enter into, I don't know what strike you're long, where you got long, what strike you were short on the covered puts there in Lulu. But one thing you could consider is, implementing the wheel strategy. What is the wheel strategy for those that don't know? Wheel strategy basically is a strategy where you find stocks that you like, where you think premium is worth selling, you sell cash-covered puts. If you are assigned and buy the shares, then you can sell covered calls against it. And you do that, and if you get called out of the stock, then you sell cash-covered puts again. Or you could start it the opposite way, in a buy right, right? So we were just talking about a buy right in ON Holdings. So you do that buy right, you buy the stock, you sell the Feb 52.5 calls, the stock goes up 15%, 20%. Let's say it goes up 20%. You collected $1.15 and change or whatever on the short calls. You made a little over $5 on the stock. So, happily you're now up 12, 13 plus %. But you get called out of the stock because you were short those calls, assuming that you don't close them before expiration, which is another way to handle it and well worth considering depending on the tax circumstances in that respective account. So just bear that in mind. You would say, is it worth closing it ahead of time? Answer is, it depends. Think about your tax situation. But assuming you did get called out of the stock, still interested in the stock, then you sell cash covered puts. That's what the wheel strategy is. So it's basically a way of maintaining similar exposure and allowing yourself to be called out of the stock or put the stock, as the case may be, as the stock rises and falls. So something you might want to consider there. Steve Garcia then asks another follow, are you concerned about the recent general weakness in crypto? I'm reading a lot of bearish sentiment about how poorly that asset class has performed, calls for Bitcoin greater than 50,000. I'm assuming you mean less than 50,000 in the second half of 26 or first half of 2026. Am I concerned about it? I am. I mean, as a Bitcoin bull, I am concerned about it in that sense. I am not concerned about it in another sense, though. Yeah, that's what I assumed you meant. So, yeah. So let's take this thing in two parts. There is the part where we're wondering just about the price of Bitcoin. And then there is the part about where we're wondering just about the state of the world. And to me, there's two things to think about. As Bitcoin goes up in price, and as silver and gold have appreciated as rapidly as they have, those things are warning signs to me. I don't like to see that happen because it speaks to a debasement trade. It speaks to a lack of confidence in fiat currencies like the dollar. And that's not what we want. What we would like to see is some fiscal responsibility out of Washington. We would like to see them curb waste, fraud, and abuse, and get on a sustainable path and stabilize the dollar and ensure that it keeps its reserve currency status. Now, what's going on with the euro? So what are the competing currencies? You have, obviously, the euro, and you have the Chinese yuan. Those are competing currencies. Then you have sort of competing stores of value, which aren't currencies per se, but end up serving as such when people lose faith in fiat currencies. And those are going to be things like precious metals and crypto. Crypto has a lot of advantages over precious metals in that, in the case of Bitcoin in particular, the amount of it that is available is known ex ante. 21 million. That's all there is. That's all there ever will be. Some of it, interestingly, in some respects, one could argue that it ends up kind of going down. And why would it go down? Well, the reason it would go down is because there are people who have accumulated Bitcoin but lost access to it. And if that access is permanently lost, then effectively the overall supply has declined. So that's an advantage that it has over silver, gold, platinum, things like this. I'm not going to say that we're going to have another Comstock lode, for example, in silver that suddenly increases supply. But it is possible that, additional supply, comes online. There is a bigger issue, though, with precious metals, which is that they are harder to transact with. It's very, you can transmit value with Bitcoin around the world effectively instantly. You cannot do that with gold. The Spanish learned that, you could get gold, you put it on a ship, and maybe the ship sinks. It takes time for it to get from A to B, and it could be lost in transit. And that is a risk. And so as you think about stores of value and then also the convenience and security of transmitting it to others, crypto holds a benefit there. So in that respect, seeing some weakness in cryptocurrencies, and if we sort of saw precious metals stabilize a bit, that would be reassuring to me about other types of risk assets and investments, including the types of ones that you hope one would make. We would like to see people invest their capital in productive ways, investing in businesses, investing in building things, making things. That's a productive use of capital, and we prefer it. And it's one of the things that I think often gets lost when folks talk about things like inflation, which is that those types of distortions discourage the best use of capital, and that ends up hurting productivity, and then everybody suffers. So to that extent, if precious metals and crypto stabilize, I view that as a positive because I have kids. I want them to go into a healthy economy. I want them to, go into a healthy society where things are working. As a crypto bull, though, I have to admit that the weakness that we have seen is quite sharp. But I would also like to encourage people to remember that I'm not going to say this is par for the course because you're kind of playing a different course in Bitcoin over the course of time. But I've shown this chart many times. I'm going to show it again. And that is that there have been many circumstances where we've seen very sharp pullbacks throughout Bitcoin's history. You can see one right here. So we'll just mark some of those off. That was an 80% decline. This peak to trough was an 80+% decline. This was a more than 80% decline, peak to trough. This was, not that. But it was a very big decline. I think we had 4 80+% declines. Now, I'm not sure if this was or not. Yeah, it's almost 80. This was 77.5%. Compare that to what we have had this time. Are we going to see this again? We're down 33% peak to trough at this point. Could this get worse? Of course. Did I think it might get worse? Yes, I've said many times that I thought that it might, at the very least, get down to that lower fib. That lower fib was also the cost basis for strategies holdings. It also happens to be, or was at the last time I looked, on or about the lowest cash cost for a miner in the world, and lower than most miners' cash costs. And that is down here, around the 74 level. Do I think that's in play? Yeah, I think that is in play. That would represent, round numbers, 14.5%, 15% decline from here is a potential downside. That is still considerably less than the kinds of pullbacks that we have seen in the past, those 80% drawdowns. Why would I think this would be a little different? Well, the asset has changed a bit. We have a much more crypto-friendly government now than we did before. Its use is, I think, much more commonplace. The other thing is that it was a very speculative asset. Hard to really make many characterizations about the behavior of some of the early adopters. But as it has matured and as you've gotten a more sort of traditional investor class beginning to participate, we have seen volatility come in quite a lot. Let's see if we can illustrate this. So I'm going to get rid of the, let me do this. This isn't really, there's not as much of a history in here. I'm going to maximize this. We'll see how far back we can go. Don't think IBIT has been around that here. So we're going to get rid of the, I don't care about, oops, no, that's the wrong one. I don't care about the implied volatility. I just want to take a look at the realized volatility, and we'll just maximize this. Okay. So as you can see, this is just a trailing 30-day realized or actual volatility, however you want to think about it. And one of the things you can see is that the trend here is generally downwards, right? And as volatility goes down, one of the things we would expect is that probably the extremes in price over both longer terms and shorter terms are going to be reduced. Relative to whatever the mean price level is, that's what that lower volatility would suggest. Is it a low volatility asset? Well, no, it's not. I mean, it's close to 50%. annualized over the trailing 30 days. So it's not a really low vol asset. But, if you think about this, what does 50% annualized mean? Well, what that means is that, the expected move over a year is going to be about 40% higher or lower, all else equal. 2 standard deviations would be 80. Twice the expected move would be 80. Twice the standard deviation. Now, of course, we're dealing with geometric return, so you're not going to say that 2 standard deviation move to the downside over the course of a year takes you right down to 0. But I think you get my point that right now, technically, it's in a bad spot. Big downside moves have happened several times in its history. And there's a couple reasons why certain technical levels that are lower than where it is right now are in play. So, I don't know. Does that mean I'm concerned? I mean, I expect assets to rise and fall. And I think this one could fall further. But I'm not a huge bear on it either, if that makes sense. I hope it does. Okay, so what do we have here? Which of the Mag 7 might have a tear in 2026 like Google did this year? I was thinking Amazon, since they have their hands on a lot of different cookie jars. So Sancho Day 1285. I, too, like Amazon. I think I mentioned it recently on Fast Money that it is one of the names I like for a couple of reasons. As you point out, they have their hands in more than one cookie jar. That is a particular strength because they are participating in the hottest performing space, but they're a retailer. They've got basically sort of have the whole thing going on. So I rather like that about their business. They're in streaming. Obviously, the biggest participant, retail. I still don't understand why they traded at a discount to Walmart, but they do. So, they've got what looks to be very strong, if you look down here, very strong free cash flow growth. I like that. Trading at a market multiple to forward, but, growing the top line much faster. So the S&P, you might expect, will grow at 5 to 6%. Anything that's growing faster than the real rate of inflation or the economy is kind of, going to be worth taking a look at. This comfortably meets that threshold. 8% CAGR for S&P growth. It has comfortably beat that as well. So, yeah, I think if I was going to play in any of them, that would almost certainly be one of the names that I would take a look at. Smitty, let's see. So, just joining the chat, have you gone over NVIDIA, Apple, and the MAGS ETF as options trade ideas through quarter one? I have not. I wrote an article recently, and I discussed this on a live stream right before I left for Hawaii, that NVIDIA is... We peeled NVIDIA actually out of one of our discretionary funds. Not because I don't love the company, everything that they're doing, leader in the space, all of that. It's just that pace of growth is going to be awfully hard to maintain. And it actually doesn't even have to, really. Let's just take a look at it, right? So the company does not need to grow at 50% per year to justify... oops. Oh, I didn't maximize it yet. Sorry. Let me do that. There we go. It does not need to grow at 53% at the current multiple to be very reasonably priced over the long term, right? So stocks, trading 188, 770 is the anticipated adjusted EPS for next year. That's just 24.4 times forward earnings. Not expensive. Not expensive if the company continues to grow at a pace greater than the S&P. And you would say, well, wait a minute. The S&P isn't growing a whole lot faster than that, right? So maybe they have 5-6% top line growth, CAGR of about 8%. That's way below what the street is expecting for next year's compound annual growth rate. I would say that the street's compound annual growth rate expectations do not extend indefinitely into the future, though. They do for the S&P, which is another way of saying that when you say, okay, I think the S&P is worth 24 or 25 times earnings, what you're saying is that the S&P's revenue growth is going to be 5-6% a year in perpetuity, and that its adjusted EPS growth is going to be 7-8+% in perpetuity. And that's an easier claim to make because, number one, it's a more modest assumption, but you're dealing with a diversified basket of whatever the publicly traded economy's best performing companies are. So even if you thought that NVIDIA could grow at the same pace as the S&P in perpetuity from its current size, it would trade at a discount to the S&P in that case because it's not a diversified business. It would almost certainly be a higher volatility business, as almost every individual business is, more volatile than a diversified basket of companies in a variety of industries are. So, my thinking on this was a little bit different because on many times I have said that I didn't think this company was particularly expensive, and I don't. And one could actually even make the same case for Amazon, except that Amazon is already itself more diversified. They have their cloud business. They have their streaming business. They have actually some financial services businesses now. They are an enormous retailer. And that is a business, by the way, that, for as long as people buy things, they're just in a very good position. I just think it is cheap as far as I'm concerned relative to the S&P because it is already diversified and growing as fast and in all the critical areas. NVIDIA, on the other hand, is a more concentrated story and either has to be expected to grow much faster than the broad market for indefinitely, if you will, or it has to be trading cheaper. Right now, it is trading cheaper if we think about it on a price to growth basis. So $7.78 in adjusted EPS for next year with the kind of anticipated growth that the company is seeing is not expensive. I just have a hard time. There's two things. One, I have a feeling that we're probably not too far away from some newer technologies emerging on the scene which change the landscape for how we think about what is required for the AI story. Quantum would be an obvious example. We have, I don't know, I'm not an expert on it, but having listened to people who are, it seems like some of the earliest estimates are in the 2029-ish time frame before usable quantum emerges. So that's like the early side of it. But that's not that far away. We're about to be in 2026, so 3 years. 3 years from potentially a complete change in the way compute works. And so I'm not 100% sure what happens to NVIDIA in that case. So to me, my thinking is everybody has exposure to the S&P anyway. Maybe peel out of a little of this. So don't have that on, but I do like Amazon. First of all, it's not quite as big, and I see their business as being quite sustainable. Mars Alien Life Form. Looking sharp. Were you a NYMEX person? I'm only asking because that is how you say my last name, but it is also that was my trading badge on the NYMEX. And everybody yells on a trading floor. They always want 2 syllables, so actually they would call me Coe on the floor. But anyway. Okay, so what do we got here? Currently just entered a PMCC position in Amazon. So poor man's covered call in Amazon with a 180 leap that expires June 2027. Yeah, like that trade. Pure and simple. I think that's a good one. Okay, so we are now at the 1 hour mark. I don't know whether Mark Guthner is available to do an office hours tomorrow. He was available, it turns out, last week, but I was not because, as you guys know, I was in Hawaii. You can probably see that I have a little bit of a tan at this point. So I did get out and about there a little bit while I was there. But on Wednesday, we're going to go over my Rising acronym. What worked, what didn't, the final tally on what the total returns for that trade worked out to be for the year. As of today, it's up about 26.7. If you had bought equal weight, all of the things in my acronym, that's where you'd be. I will have a new one for 2027, and I will go over that on open mic on Wednesday. Haircut. One of the things I wanted to get my hair cut while I was in Hawaii because humid, hot air, what little hair I have on my head gets pretty frizzy. And when I got back, the first thing I did was say, let's just shave this off, for crying out loud. Hopefully we have office hours tomorrow. If not, I'll see you guys Wednesday. And thank you all very much for watching. We'll see you soon.